But before that, I would like to, of course, acknowledge with respect the Lekwungen-speaking peoples on whose traditional territories the university stands, and the Songhees Esquimalt Wasanic peoples whose historical relationships with land continue to this day. I'll be very brief. Like I said to those, maybe some of you weren't here, but I've been looking forward to hearing from Aaron for a while. So my dream as a researcher in the energy space is always to come up with some brilliant idea and to see it transferred out of the lab and into commercial use. And I've seen a few colleagues attempt to do this on their own, and it is a really difficult thing to do. At least that's what I've learned. But I really admire people who go into that space and take it on. There's this high risk, high reward part to it. And Aaron is, Aaron's one of the old, I'll use it because I think I can, one of the old IESVic members from back when the Institute first started, and really, I think, went down this path that a lot of us sort of believe we might get to as researchers. He went through an engineering program in this energy space, through the IESVic cultures, learned about strategy, and then has gone on to really be in the innovation and startup side. And that's where I think Aaron's going to educate us a little bit today, at least myself. And I know he'll tell you more, I'm sure, but a vast array of experience with different types of energy conversion technologies. So I won't say too much more. Like I said, Aaron's got a lot of experience, and he's mentioned he's got about 35 minutes. So at the end, we should have some time for a bit of discussion and some questions. And Aaron, I look forward to hearing from you. You take over.
That's great. Perfect. Thank you so much, Andrew. I really want to use today as a chance to talk about sort of the background that I've had, the career that has taken me through working with a number of early stage energy companies, and ultimately leading to what I'm doing now, which is running my own venture capital firm, investing in early stage energy companies. So let's just get that started here. Okay, and I think we are good. Success. Okay, so as was stated, my name is Aaron Fyke. I think I was actually the first undergrad affiliated with IESVic. I joined the summer of '93 as one of my co-op terms working for David Scott. We published a great article on exergy recovery of liquefied hydrogen, or LNG, as fuels. I then graduated top of my class in '95 with a BEng in mechanical engineering. And so what I'd like to talk to you today is this journey that I've been on, a journey as an entrepreneur, and a journey that many people seem to be interested in embarking upon. So I thought that you might find this interesting to hear of my background. So in that time, I've been the founder and co-founder of 6 different companies, CEO of 2 of them. I've been a venture capital investor, both in what would be called Cleantech 1.0 and now Cleantech 2.0, and I own my own VC firm, which is Thin Line Capital. But this is also the story of Cleantech itself as an investment class and as a startup thesis. It's been through some interesting times, and now, as exciting as things have been, I feel like we're just getting started, but it's definitely useful to look back at its history. So my journey begins at Ballard Power Systems. I worked there until going to grad school in 2000. So I'd like to call this era Cleantech 0.1. It was really just Ballard at the time, although I was also involved with some things at BC Research up at UBC, working on what was called alternative fuels and electric and hybrid vehicles back in '95. But it was the first wave of investment excitement in the space, and a precursor to what would follow a few years later. So Ballard got caught up, this is their stock price, got caught up in the market frenzy that was the around 99, 2000 in the dot-com era, which I'll talk about a bit later. And they were going to change the entire automotive industry, becoming the Intel chip, inside every car. Fuel cells were the future. Ballard's peak market cap hit $32 billion US. And for comparison, that was almost 1/10 that of Microsoft at the time, or twice that of Apple at the time. And but then the dot-com bubble burst, dragging down the market, and Ballard with it, which would ultimately take years to recover. In fact, Ballard has never recovered to those valuations. The next phase of clean tech was actually called Cleantech, similar to how Netscape's IPO kicked off the dot-com era or Google's IPO kicked off Web 2.0. It's really SunPower's IPO in 2005 that caused the frenzy of activity that lasted somewhere into about 2008, when the global financial crisis brought on by the mortgage crisis hit. And you can see what happened there. This is a collapse. This caused a collapse that lasted years. And this graph is a pool of clean tech public companies called the Wilder Hill Clean Energy Index, where I pulled this from. So after the clean tech crash, there was what I like to call the long winter. And I just showed that to you now. This is the period from 2009 to about 2016, when it was extremely difficult to find any investor interest in the space. And it was at this time that I started or co-founded a number of companies. You can see them here. Soliant was a concentrating solar company. Starfish Ventures was where I first joined a VC firm based in Melbourne, Australia. When the bubble collapsed, I returned and joined the X Prize Foundation, where I got the idea for grid scale energy storage company Energy Cache. I helped start drone agriculture company MicroSense. And when Energy Cache shut down, I immediately became the CEO of Heliogen. And then I got involved in Hong Kong-based battery storage company Amped Energy. And finally, I helped co-found Energy Vault, which was a restart of some of the concepts we had explored at Energy Cache. And around 2017, I sensed that things were going to change, that we would be entering a second phase of clean tech investing. And so I started Thinline Capital to invest in this new phase. And then this happened. I call this era clean tech 2.0, although it now actually has many names: energy/sustainability, Climatetech, Greentech, clean energy, circular economy, and several others. The stigma from clean tech 1.0 was so bad that people are not comfortable even using the name, such like you don't really hear the name .com around much these days. But now it's much, much bigger than it was even before. So these are the companies I've started, invested in, or have had invest in me or with me. So I'd like to give you a little more information on the why that I'm so excited about this period. So clearly I've shown you a pattern of extreme enthusiasm followed by extreme disappointment. So what's different this time around? And the first off is the market drivers are really massive. These are trillion-dollar industries that are being disrupted as we move to a zero carbon economy. So this is important to know. When things stay the same, this will favor the incumbents in the industry. The established companies have all the advantages. However, when things change, this is what favors startups. So just like the internet disrupted the telecommunications industry, the boom in energy consumption, the threat of climate change, and the need to address the infrastructure debt that has been building has created tremendously strong market drivers. But what's different now is that, so 10 years ago, all of the clean tech companies were extremely capital intensive. Biofuels refineries, concentrated solar projects, big biochar projects. We were using VC dollars to build out industries, which was really a big mistake. This may make sense for a whole new category, internet search or social media. However, in the traditional energy industry, this was a big mistake. However, today, the solar industry, the wind industry, EVs, battery storage, and grid modernization industries, these are all sufficiently large such that there are a host of more capital efficient companies now that are selling into these industries rather than trying to build them out in the first place. And that's a key difference. And I really want to take a moment to draw parallels between the .com investing era and the era post-crash, which saw the rise of Google and Facebook and then Netflix and others, and what we saw in Cleantech 1.0 and what we're seeing today. So 95 to 2001, internet companies see incredible rise and fall in valuations. The .com bubble is seen as a period of irrationality and hype. What happened? There were strong drivers for growth, connecting everyone in the world. There was a huge market potential, multi-billion-dollar markets. There were tremendous expectations. Companies were building out the internet, both in terms of users and physical infrastructure. There were a lot of crazy companies burning cash, Webvan, Cosmo. and many inexperienced investors entered and then were forced out of the space. So what happened next? Well, then new companies came along and built on top of the existing networks and existing users that had previously been established. And there were new opportunities to service this existing user base that didn't exist before. And there were more capital efficient paths for a web company. You could use Amazon Web Services or a software as a service business model. Back in '96, if you wanted to host a website, you generally had to hook up a computer and host it yourself. That just wasn't necessary building after 2001. So the result was that 2004 to 2005 was the time to return. 2003 to 2008, we see Cleantech companies are seeing incredible rise and fall in valuations. Cleantech bubble was seen as a period of irrationality and hype. There were strong drivers for growth, the world's energy system, huge market potential, trillion-dollar markets, expectations, building out the clean energy infrastructure, solar, wind, biofuels, both in terms of users and physical infrastructure. There were lots of crazy companies burning cash. And just like we saw earlier, many inexperienced investors entered and were forced out of the space. So what's happening now? Well, just like before, new companies are coming along to now build on top of existing installations and existing users. There are opportunities to service this existing user base that didn't exist before, and there are more capital efficient products that leverage existing deployed capital. So the result is that now is the time to return. And this slide was in my pitch deck to raise inline capital back in 2018. I was trying to convince people of the opportunity. It now almost seems self-evident because there's tremendous interest in this space, which I was trying to say was coming. So the investment thesis with inline capital was that I want to invest in low capex investments that leverage the existing installed base of industries transitioning to a zero carbon economy. Or because I've been a serial entrepreneur before, I want to invest in companies that I wish I had started. So that's inline capital. So we're going to take a turn now in the presentation, and I apologize for the abrupt change in graphics, but I want to transition away from my experience and the experience with inline and move to talk about the broader economics and activity in this space. So I have a lot of data that will drive these points home, which I think you'll find interesting. Our global economy is undergoing massive changes. And keep in mind, for some of these slides, I haven't actually updated them in a couple of years, and certainly not since the pandemic. So in many ways, the effects are even stronger than what I'm about to present. So here's what's already happening. On October 2014, the governor of the Bank of England made the announcement that the vast majority of carbon reserves are unburnable. Okay, so what does this mean? So we are overburdened by subprime carbon assets. These are all the fossil fuels burnt since 1850, the same year they discovered that CO2 traps heat, by the way. 1,800 gigatons of CO2. You could almost say that these are the total emissions historically released by humanity. Now, this is what we've burned in the last 15 years. This circle is what the companies, countries, and states say they have in reserves of oil and coal and gas on the books. 2,800 gigatons of CO2, more than 1,000 gigatons more than we've burned for all of humanity. Oil and gas companies' stock price is determined by their proven and probable reserves. And this little bit here is what we can actually burn and stay under a safe threshold to avoid catastrophic consequences to humanity. That is a 50% chance of staying under 2 degrees. The rest is unburnable. And you can see that what is left is about what we burned in the last 15 years. So what happens to the stock markets and the global economy when the holders of those assets, who are under the assumption that they'll be burned, realize that they can't be burned? That's $22 trillion. These are the subprime carbon assets. So remember the subprime mortgages behind the global economic downturn. There was a collapse and a run on the banks in the Great Recession. So now we have a lot of subprime carbon too. So what about this $22 trillion when people realize that is worth zero? I wanted to compare the subprime carbon assets with the subprime mortgage assets. If 22 trillion is at risk now, how does that compare to the mortgage crisis? So remember that the subprime mortgage crisis caused the biggest economic downturn since the Great Depression. So the subprime carbon losses are expected to be $22 trillion. And the write-downs of US originated assets due to the mortgage crisis was $2.7 trillion, according to the IMF. The economic time bomb that is brewing in order to avoid global catastrophe is 10 times bigger. So in this scenario, the last one holding the bag will be the ones to lose money. And because of this, the largest sovereign wealth fund in the world, in Norway, has proposed fully divesting from all oil and gas assets. The biggest investment trade of our generation is going long on renewables, buying renewables, and short fossil generation, getting out of fossils. And let me tell you more about that. So in July of 2019, BP's head of strategy admitted that some of its unextracted resources won't see the light of day. And I want to show you something. Here's the S&P for the last 10 years. And here's the S&P energy sector. Reuters says that energy has been the worst performer since the US bull market began more than a decade ago. Here are the returns on investor capital for ExxonMobil. These companies are in trouble and they've started recognizing it. In August 2020, BP announced that it would cut its oil and gas production by 40% and increase spending on low carbon investments tenfold by 2030. I had this slide in there for BP, but this has been such an astonishing month. I've added 2 more slides, one for Shell and one for Exxon. Both happened June. It means halfway through June now. The first week of June, i.e. 2 weeks ago, was a big week. A Dutch court ruled against Shell and found that the company had contributed to climate change and ordered that it cut its emissions by 45% by 2030 compared with 2019 levels. That is absolutely seismic. And then on top of that, also in June, a small hedge fund called Engine Number One secured enough votes to put 3 people on Exxon's board, pushing for cleaner energy solutions. If you look at the new investments, at least in the US, but this mirrors globally, in fact, the US is one of the laggards, it just keeps going up. And this graph was created before the Biden administration announced their aggressive multi-trillion-dollar investment plans. If you look at the stock market returns in the clean energy sector, they've gone up 60% in the last 3.5 years. And so what about fossil fuel companies? They've gone down by 12% in the last 3.5 years. Pandemic and post-pandemic recovery notwithstanding. So let me talk about where we've come from. People don't really realize the extraordinary progress that we have made. So let's start with wind. And keep in mind that wind is actually the least exciting of what I'm about to talk about. So back in 2000, there was a projection of, well, how much wind could we really deploy? And the expectation was that worldwide wind capacity would reach 30 gigawatts by 2010. But the reality was, by 2019, that goal was exceeded by a factor of 22 times. We see that global wind energy capacity is taking off at an exponential rate. Now, I love this headline. This came out in 2019. Wind to surpass hydro as #1 US renewable power source in 2019. Now, in case you didn't realize, the US doesn't have quite the hydro resources that Canada has, but they have a lot of hydro, 300 million megawatt hours worth. That's more than all of California's electricity consumption in 2018, which is 285 million megawatt hours. So more than all of California's electricity consumption a year is what is available annually in hydro in the US. And the headline from February 26, 2020, wind has surpassed hydro as the most used renewable source in 2019. In fact, wind in 2020 is now as low as $26 a kilowatt hour unsubsidized and $9 a kilowatt hour subsidized. The US, and I've had to update these slides, the US has 125 gigawatts of wind energy installed, enough to power 37 million homes. But if you look at what's happened in the UK, it's even more astonishing. So in Scotland, they're getting twice as much wind electricity as they need for all of their homes. And in England, where the coal revolution began, in 2018, they got 3 times as much energy from wind as from coal. And by 2019, the UK generated more than 18 times as much electricity from renewables than coal. There's a really neat story here. I want to walk through this because it's just this astonishing change. And mostly because I keep having to update these slides, so it's interesting to see. In April of 2017, Britain went a full day with no electricity from coal. And that is the first time that had happened in over 130 years. However, in April of 2018, they went 3 full days. And let's see what happens in 2019. The dire predictions in the 1950s, Britain will fail without coal. And here's a more recent headline. By the way, it's the same newspaper, it's The Guardian. Great Britain records 2 weeks with coal-free electricity generation. And then May 19th, 2020, Britain went the first month with no electricity from coal. And then by 2025, there will be no more coal burned in the UK. So people say the energy industry moves slowly, and it usually does. But let's review. 2017, the UK went 1 day with no coal, 2018, 3 days, 2019, 1 week, and in 2020, 1 full month. And by 2025, 0 coal in the UK. And if we look at the whole world, wind energy could supply about 40 times more electricity than the entire world currently uses. Okay, so let's move to solar, where I'm more involved and I'm super excited. Same predictions. Back in 2002, the expectation was the solar energy market would grow 1 gigawatt per year by 2010. But the reality was that goal was exceeded by a factor of 17 times. And by 2019, it was exceeded by 121 times. And we see the same exponential growth in world solar PV installations. And it's for the exact same reason, the dramatically declining costs. $80 a watt for solar in 1976, down to about 20 cents a watt today. And so we see similar thing. The US has 96 gigawatts of solar energy installed, enough to power 18.5 million homes. But it's not just developing countries. In many countries where there's no universal electricity grid, we're seeing consumers and businesses leapfrog over old technologies and install solar panels in places that have long been denied access to electricity. It's basically exactly the same as what happened with landline telephony being leapfrogged for mobile phones. We're seeing the grid being leapfrogged for solar installations that have low upfront costs, and they become more affordable for developing countries. And Chile is an astonishing success story. The country's solar market took off slowly. In 2013, there were only 11 megawatts of solar installed. In 2016, it was 1.1 gigawatts. By 2018, it was 2.3 gigawatts. But look at what is happening now. There are over 16.7 gigawatts of projects installed or in progress in Chile today. And there are many regions of the world where this type of growth and development are possible. So every hour, the Earth gets as much energy from the sun as we need to run the entire global economy for a year. Okay, so I learned this from a speaker who I really admire and respect. He listed the 3 renewable energy tipping points. We will completely replace fossil generation worldwide with renewable energy when these 3 criteria have passed. The first is that when renewables are cheaper than new, when it is cheaper to build a new wind farm than it is to build a new coal plant, factoring in lifetime costs and fuel, maintenance, etc. So we've passed that. The second is that when renewables are cheaper than existing, when it is literally cheaper to build a new solar farm than just to shovel the coal into an existing coal plant. We've passed that. And the third is when we get really cheap storage. So these tipping points were presented by my co-founder and mentor, Bill Gross of Idea Lab. So let me talk about the first of these. To give you an idea of how fast things can change, think back to 2008. It wasn't really that long ago. However, since that time, everything has changed. And the changes in the next 10 years are going to be even more dramatic. So if we look at residential PV, costs have dropped 55% since 2008. Utility scale PV, 71%. Wind is down 75% in cost. EV batteries are down almost 80% in cost. And if we look at LED light bulbs, which used to be sort of a curiosity, those dropped 94% in cost in a 10-year period. And now they're ubiquitous. So to give you some context on the scale of these cost reductions, I want to point at this headline on Bloomberg from 2019. Because of these declining costs, the International Renewable Energy Agency said that global investments needed by 2050 in clean energy to meet the Paris targets dropped by over $10 trillion over what was previously estimated, because things have gotten so cheap. So let me talk about renewables cheaper than existing fossil. I showed this a little earlier with the UK. Coal is going away. Out of interest, here's what's happening in the US. So these are the plants that were proposed to be built and then defeated. Here are the ones that have been retired. And here are the ones where the retirement has been announced. All of these plants have been canceled, and the trend is the same globally. By February of 2023, the US is expected to retire another 19 gigawatts of coal-fired generating capacity, and in the same time frame, the US will add another almost 200 gigawatts of solar and wind generating capacity. So now let's look at the third tipping point. If renewables right now are cheapest form of general energy generation, fossil, especially natural gas, is what's used to balance the variability of renewables. And this is where storage can play a huge role. So let's look at what's happening there. So I mentioned Bill Gross earlier. He and I are co-founders of Energy Vault, which is tackling grid scale energy storage. And we've been looking at this market for at least the last 10 years. And the reason Energy Vault is really exciting is due to the market growth. So let's look at this. Here's the historic energy storage market. But hold on to your hats, because this is what's coming. Over 125 gigawatts of storage needed in the next 10 years. And again, due to collapsing costs of storage, $1,200 a kilowatt hour for lithium batteries in 2010, down to $200 today. This is why Bloomberg said that solar plus batteries is set to begin a dramatic transformation in human civilization. Collapsing renewable prices and collapsing storage prices will eliminate fossil generation from the electricity grid. Okay, so that's electricity generation. What about transportation and electric vehicles? Same thing. So here's the cost of batteries for transportation applications. From $1,600 a kilowatt hour in 2000 to around $200 a kilowatt hour today. And actually, the truth is, I actually know that number is substantially less. This is heralding the explosion of the EV market. So what is the cause of this? So these markets are volume-based commodities games. As scale increases, prices collapse. So not many people know this, but back in 2017, the number of battery megafactories, like the Tesla Gigafactory, under construction was 17. People think the Tesla Gigafactory is unique, but it is just one of those 17. However, that number as of 2019 has jumped to 70, as reported by Benchmark Mineral Intelligence, a commodities analytics publication. 70 battery megafactories are under construction around the globe. EV prices are going to collapse. And a consequence of this, well, here's the powertrain cost curve for an efficient gasoline-powered car, and here's the cost curve of an EV. 2023, 2024 is where the lines cross. In 2023, 2024, you'll be able to buy an EV at price performance parity with an internal combustion engine. And that will be the beginning of the end for the internal combustion engine and the beginning of the explosive growth of EVs. And I really like this graph. It's really interesting. It basically outlines the end of the internal combustion engine fleet globally. ICE stands for internal combustion engine. So first, the EV range is limited, then EVs are more expensive than ICE, then EVs reach price parity. It's shown here 2020, it's more like 2023, 24. Then EVs become materially cheaper than internal combustion engines. Then owning an internal combustion engine becomes socially unacceptable, kind of like smoking. By the way, Norway is here. Then ICE leases become 50% more expensive than EVs because the auto manufacturers don't want the cars to come back because they won't be able to sell them. Then leasing and ICE becomes impossible, and then we move out where new internal combustion engine residuals trend to zero. Oh, one other point, where it actually says Norway is here, that was actually true in 2017. 2019, they were here, and last month it was announced that Norway is now here. Almost 80% of new vehicle sales in Norway are EVs. So here are all the auto manufacturers that are shifting to the manufacture of electric vehicles. All the R&D is going to EVs now, not marginal improvements to the internal combustion engine. 35 cities around the world have committed to buying only electric buses within the next 5 years. I've highlighted 2 of them, Los Angeles, where I now live, and Vancouver, where I used to live. So the market is really growing. By the way, in China, Shanghai and Shenzhen have already stopped buying any buses other than electric buses. So this has been a really tremendous journey for me, and as you can tell, I'm even more optimistic about the path ahead. But I wanted to close with a couple of thoughts about being an entrepreneur. I've been really passionate about what I've been doing, and I've known that I've wanted to work on clean energy since taking David Scott's thermodynamics class, MEC 240, back in 1991. And yet at the time, I didn't know that I wanted to start my own VC firm. I didn't even know how to spell VC. And that's okay. I didn't know I wanted to be an entrepreneur. That didn't come out much later. I just kept pursuing what was interesting and building on what I had done before. So I think what's important is that you don't need to know what you want to be, just what's interesting to you. So I just kept learning as much as I could and stayed true to what was interesting to me. And to really drive this point home, I had a huge interest in computer science and graduated right at the birth of the internet. And I still didn't pursue that. I wanted to be involved in clean energy when nobody was talking about that. So it isn't always about what's hot. The path isn't always straight, and that's totally okay. And so secondly, when people talk about entrepreneurship, they say that you must have passion to be able to grind through the hard times, as I just mentioned. And while this is important, it's also not really prudent. Passion alone just isn't enough. So be sure to support yourself in a way that you can grind through the hard times. So don't raise money too quickly. When I was getting the fund going, I secured a number of random consulting jobs to let me buy groceries and pay my mortgage. I wasn't getting rich, but I was basically just kind of keeping the ship afloat. But what that side income let me do was devote full time to getting Thinline going, while at the same time, it allowed me to take as long as I needed. I wasn't going to be forced into accepting bad terms or partnering with people I wouldn't have wanted to because I was desperate. So support yourself and give yourself options, and don't worry about rushing the outcome. So that is everything that I wanted to share with you today. And thanks for taking the time to listen. And I'm happy to answer questions.
Thanks very much, Aaron. That was fantastic, as I knew it would be. And I'm sure there's probably some questions and comments. I'm going to kick it off though with one. So you sort of had this question lined up a little bit while ago, and you came right back to it at the end. So thinking about low capex energy investments, you mentioned sort of computer science and the internet. I'm wondering if you can comment on this whole convergence of sort of blockchain opportunities, peer-to-peer energy trading. What's your sense about this? I keep seeing it, and I'm not sure what to make of it.
So blockchain is a distributed ledger. It's basically saying that there is no central repository, and that works great as a currency because there is no one place that it can be hacked. I've seen a number of companies trying to do blockchain things related to carbon trading and carbon mitigation efforts and accounting for them. And their intention is to drive down the costs of tracking carbon mitigation efforts. I haven't invested in any companies like that because I think that, that at least with the companies that I saw, there was no real advantage to being a distributed ledger. Like, quite frankly, the company would have done much better if they just hosted a big Excel sheet and they were the central point of contact of all these micro CO2 mitigation projects. It felt a bit like that, they were trying to do blockchain because because saying blockchain would likely get investor interest. You have to look at what blockchain does well, and at least in these particular opportunities, they weren't playing to blockchain's strengths. The other disadvantage with blockchain, and this is more for Bitcoin as this is the proof of work versus proof of stake. The existing blockchain models, which validate that you really own the currency you say you own, is by making a bunch of computers crank away. And I believe now Bitcoin consumes as much electricity as Argentina. That's clearly not sustainable, and completely a waste. Now, that isn't a complete ding on blockchain itself or cryptocurrencies, because there are other currencies that have a much less energy intensive way of verifying that people have what they say they have, and that's this proof of stake versus proof of work. So I believe that can be solved. People ask a lot about cryptocurrency's use of energy, and although it's atrocious, I don't think that's an unsolvable problem. So let's say you have a blockchain use that doesn't suck up an entire country's worth of electricity. The question remains of, okay, so how is this going to reduce cost or reduce friction or make it easier to have transactions in some kind of marketplace? And carbon trading comes to mind because there is a lot of overhead right now. The challenge is that it's not the currency, in my opinion, that needs to be improved. It's that if you declare that, oh, I'm a farmer and I plowed in all this stuff into my field so my soil will capture carbon, it's someone has to go out there and check that you actually did do that. And that's not a blockchain solvable problem. I think the bottleneck with CO2 trading is in the certification and verification, not in being able to, once it's been verified, being able to sell those credits to the right people. So I kind of feel like blockchain is, at least in this space, I haven't seen a really good application. But that being said, the notion of a distributed ledger and a very low cost accounting system that's shared globally is pretty attractive, and there may still be something that makes sense, but I haven't seen anything yet.
Okay, good. Yeah, this is an evolving space. It's pretty interesting. Ralph, Did you want to ask a question? I see you type something in, but it might be easier for you to just ask.
Sure. Just leading on from that kind of tech discussion, I guess, into the ML AI space. I was just at a conference where we talk about this regarding energy use in buildings, and we'd love to be doing more with machine learning in that space. And apparently the big players are putting 100 billion into driverless cars, because that's where the AI mega train is going at the moment. Any thoughts on how we can bring some of that to bear? And perhaps I'll add an addendum to that question in terms of talking about the demand side as well. You've talked a lot about supply of energy. How do you see this spreading out to the reducing the need for it in the first place kind of arguments, companies in that space?
So so when I said I wanted to start a fund to invest in low CapEx opportunities, I might as well have just said I want to invest in AI and machine learning applications, because of my 5 companies, 6 companies, the one I'm doing now, 4 of them are basically some kind of machine learning optimization, applied to different markets. So I've the company that I invested in called Digital Harvest is serving the agriculture industry, using machine learning and data analytics and optimization to give better predictions of the sugarcane harvest. The applicability to climate change is that one of their first customers was US Sugar in Florida, and when I talked to the general manager there, he was saying, Florida isn't Florida anymore. Their traditional management techniques for predicting the optimal time to harvest sugarcane don't really work. Florida is now much more like Indonesia. And so, and Indonesia has the same problems, and Mexico has the same problems. All these whatever their climate was, it's not what it used to be. And in Digital Harvest's case, if it looks like another climate where there is a bunch of historic data, which it is, they've got customers in Mexico and Indonesia and Florida, then they have an advantage of being able to train a data set in an Indonesian climate and then apply that into Florida, which now has an Indonesian climate, and give really good solutions. So that's sort of my, I invest in things that will either help mitigate or help us adapt to climate change. That's more in the adaptation side. They're not going to reduce any carbon from the atmosphere, but they will help agriculture systems respond to these shifts. And that's entirely a data analytics play. I'm actually at one of my other companies right now at an offsite company called Divarod. And what they do is similar thing. They do monitoring of water levels, but because they've got all this historic data of real-time water levels, they can, provide better predictive analytics on flooding risk. And what I liked about them is I had looked at a number of water companies. I think I looked at my list, it was like 24, and four of which I really wanted to do, and I ended up never pulling the trigger. But all of those companies treated water as an asset. And the trouble is, water is an asset. We need better desal, we need better, we're always in a drought. But the trouble is, water is never priced appropriately for various political reasons. It's all but basically free. And it's really hard to build a business, selling something free. And what Divarod did is treated water as a threat, as a liability, not as an asset. And which it is, by the way. There's I think it's $5 trillion of real estate in Miami is threatened by sea level rise by 2070. So what they look at is predictive analytics for providing very detailed risk maps, like down to the address level, of storm surges and floods. And of course, that's only going to get more serious. That's entirely a machine learning play. I mean, they have a bunch of data, but the predictive analytics come from the machine learning. Another company I'm working with is basically Google Maps with the grid. They can help utilities determine that if this neighborhood is this many electric vehicles and this one is this much rooftop solar, where is the place where it's most valuable to install energy storage, for example. And so a big part of my thesis, and when I say low CapEx opportunities, it's people taking data analytics or optimization solutions and applying them to different markets. Sugarcane, building out the electricity grid, handling water risks. So yeah, there's a ton of interest in self-driving cars, like no question. And part of that is because a bunch of very well-funded players all want to do the same thing at the same time. And that leads to that, like Tesla and Uber, and I mean, I even heard Apple and Google have been working on this stuff, and they all have infinite money, so they plow a bunch of money into it. But that doesn't mean that I don't want to say that that's distracting or taking away from other applications. It's more like all the opportunities that I'm seeing is somebody taking a new thing. And by the way, you're talking about, I've seen, building efficiency, more efficient heating and cooling stuff. I don't know if it's necessarily machine learning, but it was certainly, taking a bunch of data and optimizing so you know how to run the building the best way. I haven't done an investment like that, but I've seen things like that. So I'm actually super excited about, not the markets that people are applying this to, but all the ones that people haven't thought of applying it to. And I mean, MindSense is the company in Vancouver where, they've got an analytics scoop of a bucket and they can see how much ore is in the bucket and whether they should, because then before you've processed the ore, how much metal is in it. Like anything that improves manufacturing, process efficiency. What's really exciting is all these industries have so much capital, farming, mining, oil and gas, there's a bunch of money in these industries. If you can just move the needle a little bit and make them more efficient, that's a massive amount of money saved. So I actually think that that's kind of what I'll be focusing on for almost the entire fund. That's a very long answer. Sorry.
Sounds like you've convinced yourself computer science is the place you should have gone.
Well, yeah, now I use Excel all the time.
So I got another quick question for you. And your summary of sort of the history was great there, and you can see the hype cycles showing up. And of course, one of them was around solar, I believe. There was this massive influx of money into solar module production. And then you saw a few big name companies that you highlighted who just got crushed. Are we going to see the same thing with batteries? I feel like the same sort of dynamic might be underway.
No, and we're not. And the reason we're not going to see that in batteries. So what happened in solar is there was something like, and I think Greentech Media published like, 108 venture-backed PV companies. Like they were they were all new, a new thin film, a new triple junction cell, they were all new technologies that would dramatically make solar more efficient. And they were all venture-backed. And then what happened is the giant machine of China woke up and just started producing like a gazillion panels, and that dropped the price down. And then all those VC companies, Cylinder included, although Cylinder really didn't do anything wrong, but they just got wiped out because VC dollars, actually irrelevant on the scale of large corporate, like development budgets. A big check from a VC might be $20 million. Well, a giant solar installer will spend billions, not an installer, but a manufacturer. So the problem is that all of these companies were trying to compete against large corporations, which was a mistake because large corporations could do this much more efficiently. Whereas in the battery game today, it is the large corporations that are leading batteries. So Panasonic is driving, it's funny, Panasonic calls it the Panasonic Gigafactory, not the Tesla Gigafactory, because their argument is like 60% of the floor space is Panasonic and only 40% is Tesla. Tesla calls it the Tesla Gigafactory, but so it is the large companies. It isn't some random startup. There are startups trying to do better things in batteries, and some of them are components like a better anode or things like this. But it isn't this whole scale. We've got a whole new technology and we're going to bring it all the way to market and compete with LG. You're just not seeing that in the battery space. The energy storage companies are either doing something like completely radically different, which is like Energy Vault trying to do, or they are a company that I've invested in is called Voltaic. They have analytics software in the cloud that they use to sell to Panasonic or sell to the automotive manufacturers. So I'm seeing all these startups playing a supporting role, but they're not trying to replace what Panasonic or other big manufacturers are trying to do. So I think what the problem was with solar is people didn't realize that just the bulk manufacturing really isn't the realm of startups. And you're not seeing that this time around in storage.
Yeah, okay, I like it, good answer. I don't see any others in the chat, so I have one more, which is really
that's fine.
More high level David Scottish type question he may have brought up way back when you had him. So the trends that you show really are this, and I heard another person talk about this at some conference, a keynote speaker, sort of a futurist look. And the thesis was the drivers are that energy costs are going to zero. Energy is not going to cost anything in the future. And that was in the context of electricity, right? When you think about wind and solar, right. And you showed the numbers, right? They keep going down. So Jevons paradox is this thing that we hear when things are cheap, you get these feedback effects where people consume more, we use more. I don't know. What's your thoughts on that? Are we into a future where it's material constraints are going to drive? That's not an energy. It's a variable cost problem anymore. It's the material and the capital. I don't know where I'm getting at.
It's fun. No. You make an interesting point because the whole point of nuclear power was, too cheap to meter and all that stuff. And then, of course, that never happened. And the argument was made with telecommunications, right? I mean, it was a long distance phone call that you had to keep short, at least when I was growing up. And now I'm on a laptop chatting with you, full video for free, basically. But the argument is, yeah, but telecommunications became cheaper, but we're actually, our spend on telecommunications has never gone down, it's gone up, which is true. I spend, well over $100 a month on cell phone bills and internet, and well, we add all that up and it's over 200. But anyway, so then people make this argument that that's what's going to happen in energy. Like, oh yeah, we're going to enter this renaissance. Energy is going to become really cheap, but just like in telecommunications, we'll layer all these things on top of it, and it'll follow like cell phones and internet and that model. And I struggle with that because now maybe I'm just myopic, but I don't see exactly what you could pile on to energy. And if you look at electric vehicles, this might be the best example. So the problem with an EV, so cars themselves are a terrible thing to buy. Like you literally buy it to park it 96% of the time. And it's probably short of somebody's house, it's literally the second biggest purchase ever. And this is the whole dream of like, self-driving cars, quite frankly. And that problem gets even more exacerbated with EVs because they literally last forever. So, well, now you got a problem, which is that you've got something you never drive. It was really expensive and it's never going to fail. Or at least, it's going to last way longer than an internal combustion engine is. So then the solution is, well, you need to use that EV like 24/7. Like that thing needs to be running all the time, because if it's going to have 1.5 million, kilometer lifetime, then you'd be stupid not to. And so EVs combined with self-driving cars is that answer. And the cost of charging that EV is completely inconsequential. It's not, like who cares what the cost was for charging that battery? The things were driven more by the lifetime of the EV and the fact that it'll last forever. And the solution is that nobody owns cars anymore. And there's fleets of self-driving vehicles, and you just like leave your door and call one and it shows up 2 minutes later and takes you where you want. And you will never own a car again. Okay, that's something I can see being built upon this new change. But other things like just basic electricity, wind and solar and things like that, I think it's just going to get cheaper and cheaper, but there's still, it'll be driven more by reliability, although it's hard to know how you can improve that. The grid has pretty astonishingly high reliability. But I think the big push is moving towards a zero carbon electricity grid. Oh, and the other thing is the solutions for everything else that we can't decarbonize is to electrify them and run them off a zero carbon grid. So, if you can use industrial ovens that are electricity driven rather than burning natural gas, and then that electricity comes from zero carbon sources. So what's going to happen is, as we try to make jet fuel out of electrolyzing hydrogen or something, you're effectively running your airplane off electricity. Which, by the way, short range aircraft, there's a bunch now that are literally like battery driven aircraft. So there's going to be a big surge in electricity demand as the entire vehicle system, like every EV is now charging off the grid, as the transportation, airplanes, ships, industrial processes, heat, anything where a fuel is burned, electrify it, and then zero carbon, make the electricity grid zero carbon. So that's going to be the main priority. And the fact that it's just getting cheaper and cheaper is sort of like, thank God, because nobody's doing this. Nobody's doing this to save the earth. They're doing it and have been dragging their feet for purely economic reasons. And I feel that if we can come out of this, it will be entirely in spite of ourselves, not because people, listened 30 years ago and did anything. So I'm glad that things are getting substantially cheaper, because that will enable moving everything to the electricity grid. And that's how we're going to get out of some of the biggest carbon problems we have.
Fantastic. Okay, so I'm going to just wrap things up. I have another meeting to go to, unfortunately, but if Aaron's willing and Jake is here and can moderate the room, maybe there's a few people who'd like to stay on for a bit. If you've got time, Aaron, I'll leave that up to you. But I do want to thank you. Actually, one of the things I really enjoyed is, so of course, being in this space, you get bombarded with information, right? Especially with the popular press now really interested in energy And so your presentation was good because you've taken the time to digest and basically summarize trends in a way that's pretty comprehensible. So I'm gonna take you up, I think, a year from now or something. I'm gonna get you back here and say, look, what's different from last time we talked to today? And there's a lot of fast change going on, so I bet you there'll be some interesting trends there. But anyway, I really appreciate the time you've taken. That was fantastic. And like I said, Jake, do you mind just taking over? I do have to run, but Aaron, thank you so much.
Oh, great. Good to see you again, Andrew.
Yeah, you too.
So,
Jake, you've got the room, okay?
Absolutely. I'll take charge from here. I'll remove your spotlight real quick. And we have a question, I believe, from Kevin Palmer Wilson, if he wants to go ahead and then take the stage and ask his question. If not, I'll ask it for you there, Kevin.
No, I can do that. Thanks, Jake. Aaron, thanks a lot for this presentation. You mentioned at the beginning an interesting point that now is the time to build businesses upon existing customers, because that's where you can make short-term or shorter-term investments and get benefits more quickly, or get returns more quickly. But how do we solve the long-term investment problems, especially for things like transmission and distribution grid upgrades, where we know that the grid just handles the variability of wind and solar better if it's interconnected, and we also know that we've got negative prices in midday in California right now that BC Hydro could potentially help balance out, but there's just a transmission system constraint there. And from what I've heard, players are hesitant to invest in that just because the project lead time of say 10 years for transmission line is so long that the market situation can change quickly. So I've got two questions for you. Did you invest at all in any companies that do kind of the hardware, the long-term stuff? And two, where do you see how can this risk be solved? Is that something that the government has to take on as a kind of a public service?
So, yeah, and this might actually be the last question because I can't stick around too much longer, but that's cool because it was a really great question, so I really want to answer it, but I'm going to disappoint everyone else who had a question after this, but that's fine. So what you're talking about, by the way, it's the same problem with the fact that Alberta can't get their oil to market because of pipeline capacity constraints. So they're selling oil at a discount, which is not making people in Calgary happy. But the solution is building more pipelines, and it's the same kind of problem. Like, that's a lot of money, and that's a long-term commitment, and that's a really big deal. And these big projects, and transmission lines are exactly the same thing. And in fact, it's literally exactly the same thing. There is a resource, BC Hydro versus Alberta Oil, that needs to get to a market, the US or elsewhere, via a large infrastructure project. I think it's going to, so no, I haven't invested in anything like that. I don't really have the horizon of my fund to do that stuff. And also it's not a very big fund. So I'm focused more on smaller companies where I can write maybe, $400,000, $500,000 check. But it's going to get more difficult because what's happening is there's a lot of money plowing into this space. And when a large amount of money comes into things, it's not looking to find companies where they can put $500,000 in it. They're looking to find mega projects where they can put $100 million at a time, hundreds of millions of dollars. And so that does encourage big scale infrastructure things, because that's a good way to soak up several $100 million rather than looking for $1 million, $100, $1 million investments. But the problem is, it's generally, rational investing aside, a big project I don't want to say it's more risky than a startup, but the risks are different. And they're certainly harder to hedge away. I mean, if the pipeline is blocked and it doesn't happen, the outcome is zero, regardless of how much money was put into it. And so it's, and with solar and battery storage not being tied to any location on the grid, then BC Hydro, although can generate electricity incredibly cheaply And hydro dams are amazing. I mean, they're basically like, they're not quite as responsive as electrochemical solutions like batteries, but they're really, really fast responding. If battery prices continue to collapse, then it doesn't make sense to string wires all the way from DC down to Los Angeles. Just stick a bunch of batteries there. And so that economics are fighting against it. And that doesn't get into everything else about NIMBYism, and it's impossible to build a transmission line anywhere because no matter where you build it, it's next to somebody and people complain, which is, the pipeline problem. Although pipelines, transmission lines aren't going to poison a lake. Pipelines have this added benefit that they may leak, but it's really hard to get big projects built. And the trend in energy is going smaller, smaller scale, distributed solutions, a bunch of networked electric vehicles that are all talking to each other so they can all bid into the market as one giant virtual power plant. So it's a non-existent but effective 100 megawatt power plant by just controlling the charging of all these vehicles. Those are kind of the solutions that don't require as much risk. They're way more resilient, and they're easier to get off the ground. Because you're not building out this big project. So I think those projects are going to become more in the realm of governments and public works efforts. And by the way, I'm not even saying they're a bad idea. I'm just saying it's a different appetite of investor, and unfortunately, it's leaning more towards that's harder to do than easier to do. The way these big projects got off the ground before is you would have guaranteed returns that you knew for sure that the people would be buying electricity as really long-term contract. And there's a reluctance for that. I mean, the reason LA plans to move 100% away from coal by 2025. Well, that's stupid. Why don't they do it now? Well, because back in the 70s, they signed a multi-decade contract, which seemed like a good idea at the time. And it ends 2025. So it's not like they don't want to get away from coal any sooner. It's just that a decision they made back then, which seemed like a really good idea. I guess you could say, I'm glad it's as quick as 2025. They could have signed something 20 years ago and been on the hook for the next 20 years. So people are more and more reluctant to sign longer term contracts because they've seen, the consequences of doing this 50 years ago. And they see that with declining costs of all these things that are more distributed, that's a better way to go. So I think what's going to happen to get projects like that moving forward is more of a public works government funding approach, which again isn't bad. I mean, that's how the nuclear fleet was built out. That's how transmission lines, that's how these things are built out in the first place. But I don't see it moving I don't see investment moving that direction. I see it moving the other way, which is going to leave the only way of proceeding would be government support. So that's my take.
Yeah, that makes sense. Thanks.
Cool. All right, Jake, thank you for setting this up.
Yeah, no worries. Thank you, Aaron. It's such a really informative seminar, and thanks for bringing all of your expertise here to the meeting today. I want to thank all the audience members for coming and then being in attendance today. Know that we'll post this on our YouTube channel so the whole world can see it, and others who were not able to join us today. But Aaron, again, great expertise. Thank you so much for your time today. And yeah, please come back again sometime.
Excellent. Cool. Thanks, guys. I'll talk to you later.
Bye-bye.
Bye now.